Guys, it's Henry, and today we've got a podcast with two experts. I think I'm allowed to call you that with all the title names, specifically US experts, and we're going to go over a bit about the hot topic at the moment, that is the US election. They're going to talk a bit more in detail about the tax side of things for US citizens living in different places in the world, mainly the UK, mainly Europe as well, and Asia, and some funds with that. So we've got James and we've got Chris. James, would you like to introduce yourself and give you a bit of information?
Hi everyone, my name is James Floyd. I'm the Group Commercial Director for Beacon Global Group. We're a 30-year-old multi-jurisdictionally federally licensed firm. We help with the connectivity between US reporting individuals, Brits in America, and any other cross-border nationalities where people could come into issues of how they get reporting and efficiency about it. And we work proudly with firms such as RCP, which is where Chris, who will be speaking next, is. And we've brought some interesting things, and it's a pleasure to speak to you all today.
And Chris?
Sure thing. My name is Chris Most. I am the Senior Vice President at Resolute Capital Partners. We're a private equity firm here in the United States that specializes in real estate, technology, and energy. And I think today we're going to be specifically talking about energy and the oil markets in specifically.
Okay, with going on to that fund, Chris, on your energy fund, can you give a bit more information about it? For the listeners, what is it about? What's it invest in? How is it good for the future with the election coming in, with both Biden and Trump? How is it going there? Because I know they've got two very different stances on energy that we've talked about before.
Sure thing. Yeah, thank you. So it's called Strategic Energy Assets 8. That is our current oil and gas equity fund. It's an equity investment. And the way it works simply is we, Resolute Capital, are the fund manager. The sponsor is named Homebound, and we are raising capital for them. They are an oil exploration and production company out of Dallas, Texas, that does the majority of their work in the Permian Basin, which, as most people know in the US, and I'm sure they've heard the name globally, that is where most of the oil is in the United States. So very well known and high producing area. Again, the funds we raise, it's a 4 to 6 year time horizon on the fund, and we're going in and we're acquiring assets. We are proving reserves in the ground and then developing them, and so increasing the barrels of oil per day. And then we exit that project in a 4 to 6 year time horizon. So that's the real fast overview of the fund, of what it is and what it does. As far as the current environment, why we're liking the environment we're in right now. So early on in the year, everything was chugging along normal, or I should say late last year even, and then COVID hit. And as you saw, the oil prices dropped. We even saw them go negative. And that was a very,
Chris,
I'd say trying time, but it was interesting.
Can you explain how it is possible for a calorific commodity to have a negative pricing?
Absolutely. So WTI, which is the index, that's West Texas Intermediate, that's all of the oil flowing into one large refinery in Cushing, Oklahoma. And so when the prices dropped, we're dropping, basically, the world stopped. So there was really no demand at that time. Everyone was home, airplanes weren't moving, nothing was happening. All this oil was coming into the refinery and they were full, basically, is what happened. So you had a couple of things happening. So there was, instead of just, zero, prices went negative, and a couple of things happened. That was Cushing telling everyone, we cannot take any more oil. If you want to give it to us, you're going to pay us to take it. But you also had professional traders in the market, because obviously oil is a traded commodity, and you can get some professional traders that can move markets pretty fast. And so it was a combination of those two things that drove it negative. It was negative for 2 days, then it came back. It was a one-time event. And I don't know, we may see it again, we may not. I don't, we could see it again, depending on, after a large recovery again, because what happens is we have to burn off all that excess inventory and and readjust production at the same time.
Just quickly, doesn't that show the volatility in oil in the ETF markets if no one are willing to take on some of that contract? So that's why better have the physical or be backed by physical substance.
Exactly, yeah. So that volatility is going to flow right through to ETFs, even individual stocks, the companies themselves. So you're going to see a lot of volatility when oil takes swings the way it did.
There was a lot of scarceness in the market at the time that these ETFs were going to collapse. A lot of the big oil ETFs. So.
Right. Oh, exactly. Yeah, that's, you know, that fear gets out there, and that's part of, you know, being invested in the public markets is, you know, fear can work its way in to the markets itself, and that's why on the private side, I mean, it's a luxury for us, I would guess, that we don't have to deal with that panic that gets put into the markets. We can actually capitalize on it.
Yeah. Excellent.
So, yeah. Well, let me bring that forward then real quick. So oil prices dropped significantly. And what that meant for us and for the fund and for Homebound is we were able to go out and start acquiring assets. Homebound themselves doesn't carry bank debt. A lot of the other production and drillers did. They had bank debt. So if you think about this, it's called reserve lending. They're borrowing on their proven reserves that are in the ground. And they were doing that at $55 and $60 a barrel. Well, just like anything, that was their collateral, and that was their loan to value was based off of that. Oil dropped, so did their collateral. They're in violation of their bank covenants now. This combination of that, along with oil companies that had higher lifting costs or higher, you know, production costs just for operations, they are forced to sell now. So we are in a position to acquire and buy. So we've made, I believe, 5 acquisitions over the summer. We're looking at 3 more right now and have a few more on the table. So that's, I was talking earlier about the luxury of being able to capitalize on that. You know, there's something pre-COVID price that we were looking at back in January at 10.8 million, which was a good deal at that point. We just closed on that deal at the end of July for 4.4 million. Same project, you know, not a distressed project or a distressed asset. It's a distressed seller. So we were able to capitalize on that.
And just looking forward to the markets, I know you can't predict it. Is there a level of price that you make a profit on the oil? And also with the elections coming up, I believe both Biden and Trump will want to have US oil or be a distributor of US oil within the US economy, because for Biden, it's clean energy. For Trump, it's US jobs, essentially. So is there something you're looking forward to for the fund in the future, or how you protect yourself, and what level of protection do you have as an oil fund?
Sure, great question. As far as our lifting cost or break-even cost, so lifting costs are the cost to get 1 barrel of oil out of the ground.
Yeah.
So Homebound has always had kind of an internal mandate for themselves to keep that at $20 or below. The projects that we have just acquired are between $13 and $16 a barrel for lifting costs. So they do things, I mean, Homebound themselves, they kind of joke about it. They call themselves a technology firm that happens to be in oil, because they do, they are large embracers of technology. So they're getting that oil out of the ground as effectively and as efficiently as possible. And then a lot of it has to do with where you're acquiring that asset. So that example I gave earlier, we can go out and buy distressed assets. That just helps our bottom line all the way. So keeping that low lifting cost is helpful, because when you get to, you know, Saudi Arabia can get it out of the ground for, you know, under $10 a barrel. The problem is they need oil in the 80s for their break even, just because all of their social programs that they have to support. Same thing, Russia's in the 50s. So, you know, being able to keep that, you know, that $13 to $16 lifting cost and keeping it under 20 allows us to keep operations going even with low oil prices. Yeah. And then on top of that, we're talking about risk mitigation. We have the ability to store up to 90 days of production of oil. So that's when oil does go, you know, when the volatility does hit, we just store oil. And as you can see in markets, even with the big crash we took, that was a 3-month event. And then things leveled off around that $38 to $42 a barrel. So while it was low, we didn't sell. When it leveled off, then we started selling what we had produced back into the markets.
And Henry, touching on the fact on the geopolitical side with this, which is always interesting as well, that when comparing lifting costs against other nations, specifically US domestic versus OPEC, that if you've got low lifting costs, you've also got the benefit of the large consumer base without having to have international transport on that, which as a classical and global economist as myself, that is the major factor that isn't included in this. And also if you add into the fact that it's actually a very good spend for any money that is spent on a federal level of assisting with the oil business in the US, it actually saves dollars spent on military campaigns against OPEC and OPEC plus regions elsewhere in the world. So as much as the US can be a net exporter of oil rather than ever an importer, sort of provides both political stability and physical stability on the sort of macro levels with it.
Mm-hmm. And James, just to add on to that, we the U.S. still does import some of its oil. While it has the ability to be a net exporter, like James said, for global stability, and as well as we blend our oil here in the U.S. We have a real light crude that comes out of Texas. So to bring in some of the heavier crudes from Saudi Arabia, from Mexico, from Canada, and those other areas, it's a blending reason, and it's also, like you said, for geopolitical peace, if you will.
Yeah. I'll just quickly touch on that. I don't think there's any time it will go under 13. Something really dramatic would have to happen for it to go under 13. But the US, as James said, it's a massive producer, massive user of oil, and also from a presidential point, from a geopolitical point, it produces jobs. It's there, and they control it. So I don't see why they would let it go over there. Whilst OPEC's, it's different to the nations, what we saw earlier with the Russia-Saudi kind of confrontation, had a massive go. So as far as from an investor's point of view, I don't know if you can say this, but it seems pretty safe from what the analysis are saying on kind of the year outlook, 18 months.
Yeah. So, over the next 18 months, we're looking for oil prices to increase because we're starting to see demand slowly come back in. Also from the fact that we burned off excess inventory. So just from the actual, production side of it, excess inventories have been burned off. Oil is what's called the just-in-time commodity. We're using what we're producing. And then, we always have reserves on hand. Most countries do. But again, those reserves are starting to drop now because of how much oil was taking off of the market. OPEC Plus took off 9.9 million barrels back in the spring. The Saudis took off an additional million. With what the US has laid down in rigs, they've taken another 3 to 3.5 million barrels of oil per day off of the markets. So all that being said, we're looking for things to come back up. But then when you mix in, like now domestically here in the US with the presidential election coming up, that you have two, polar opposite really candidates when you're talking about the oil markets. This is going to be some opinion now, so I just want to make sure everyone understands that. But you've got, again, Trump on one side and Biden on the other. The dirty little secret is oil's been around in all administrations in the past, whether they're Republican or Democrat. One thing they talk about a lot on the stump, as they say, it's to get elected. They'll really talk about the points of their party. But when all's said and done, they really end up leaving things alone because the revenues generated from the oil industry, from the tax side of it, is the second largest contributor to the US Treasury, right behind income taxes. And there's very few politicians that are going to shut off their number two inflow of cash, especially into the government side. Biden has said that he will stop permitting on federal lands. And that's, as far as we're concerned, it does not affect homebound because in Texas, almost everything is state land. So that's the state that controls it. We do have some properties in New Mexico and Colorado, and some of them are on federal lands. However, they've already been drilled and they're producing. So if he were to do that, that would in turn, those would be grandfathered in. So it would just be federally on the federal lands, they'd stop permitting for new drilling. So in the short term, for both administrations, they both have the reasons of why prices would go up, because now you're going to have drillers that are on federal lands coming in and trying to, crowd the state-owned markets. And so we're going to have a little battle going on there for people trying to acquire land, and that federal land, they're counting on future production from that. So again, they'll factor in that, we're not going to have that future production coming off of federal land. So again, that's going to put some price pressure to move things up. And then on the Trump side, like you said, absolutely. It's, the oil industry does produce a lot of jobs here in the US. And that's his big push. His big push is for that job market, as well as the energy independence and national safety. That's his big thing, is that gives us safety in the world because we are energy independent and we can hold our own.
Yeah.
The funny part about the whole thing is the alternatives market really needs the oil and gas market, because you can't make windmills without petroleum byproducts. You can't make a Tesla car without petroleum byproducts. All the plastics in the car, the rubber on the tires, the roads, our asphalt roads are all petroleum based. Pharmaceuticals, plastics, the N95 mask we have, we have fun with this one. That's made by a company called 3M, and 3M headquarters is about 6 miles up the road from me. And their N95 mask, everything in there except for the nose clip and the staples that hold the straps on are petroleum byproducts. So while there is pressure on, obviously, to get to greener markets in the U.S. or greener energy,
Biden especially.
Yeah, it's what oil is needed, and then we look around globally as well. You still have growing middle classes in some of these developing countries where there is going to be a need for either oil, gas, or their byproducts.
Which is a nice thing to touch on. I mean, it is our duty of those of us that are finance professionals to add ESG slants to everything we do. And it's something you point out, is we are not moving away from petroleum products for a very long time. They're going to be part of it. But there is an aspect that we have to put an ESG responsibility aspect onto how we do this. So it'd be interesting to touch on this, because you mentioned how Homebound are a technology company, of actually how these ideas are incorporated to, it's a cliche, caveated again massively, but this is the greenest, most ethical oil fund that one could consider.
Mm-hmm. It is, and I'll touch on that real quick as to why. Right down to, so when the oil gets pumped out of the ground, it goes into storage tanks on the site, and then with the storage tanks have a pipe that comes off that they connect a hose to and put into the trucks. They have a basket, it's a plastic basket, if you will, around that connection. So at any time there's a connection, of course, you're going to get drips of oil. But that basket, that's a plastic bin, if you will, that surrounds that connection. So when that connection is made, that oil does not hit the ground. They have small little berms, if you will, or barriers around the oil pad itself. In the event there were a spill, it would be contained within the oil pad area. They have third-party plans in place in the event there was a spill or something on site. So they have these contingency plans in place to take care of that. Right down to the pump jacks. Those are the things, the pumps that are going up and down. You see them pushing the oil. They are, we call them smart pump jacks now, if you will. They have the ability to speed up the flow, slow down the flow, and shut themselves off automatically. So they can sense what's going on. They have sensors where they're able to shut down if something goes wrong. And then just from a human aspect, Homebound has someone on site twice in every 24-hour period. So every 12 hours, somebody is on site checking every well and making sure that they're functioning properly and that everything is working okay as far as the equipment goes.
Wow. Well, thanks for that, Chris. That's a really detailed explanation about the fund and the oil. James, if you can go on a bit about the tax side for Americans and how they can utilize that if they are an expat in the UK or elsewhere in the world as an American.
Yeah, especially globally. I mean, it's easier to report sort of this back in. I mean, the good thing about it of working with this is that we've made accessibility to these funds on a global aspect. So there's no consideration of withholding tax or any other application with it. So one can access these funds either through a referral agreement directly into the US or via Guernsey feeder funds through into the Master Delaware Fund to ensure that the most tax efficient elements are in there as well. There are constant returns that are available for it. We're striving for sort of 6% returns and IRRs attached to it in the mid-teens, but all this information can be found through asking Henry for greater information through this. The aspects on this as well, that if someone has a US tax responsibility, they are reporting globally, no matter where they are, on all income or unearned income or capital gains. The US, due to their unique tax position, means that US citizenship overrides everything else. So if one was to be working in a low tax environment or tax-free havens, the only tax they will be paying will be their US tax, paying that on an annual basis, which they, well, with between FBAR, WBEN, and 1099 forms they'll all be sort of completing now. So that's the kind of, it can be the entirety to what an expat is paying. Obviously, as well, of those that are paying US tax, it's not just US citizens, it's those with economic interest in the US, those born of an American, those with a green card that's still in force and haven't given it up yet, which is another sort of interesting anecdote of rescinding your citizenship or your green card has been impossible because embassies have been shut down due to COVID. So actually the ability to remove your tax reporting obligations are pretty much removed this year, which is an interesting fact to it. So I will sort of let Chris touch on this as the technical professional with it, of what the difference are between tangible and intangible drilling costs. But what this really means, and please come to us for further information with it, but if someone is living in a high tax or low tax environment, but still paying, they will be paying their US tax to it. They have the ability of making that tax bill reportable to the US zero by using these things. Heavy caveats with all of that of how that's possible, and sort of allow Chris to do it. But the opportunity for sort of getting gross exposure net and only costing net with that is always very attractive. But Chris, do you want to touch on tangible and intangible drilling costs and sort of
Sure.
how that works, or sort of usual demonstration?
Absolutely, absolutely, I will. So like James was saying, you have the ability to write off 100% of your investment against your income. And allowing you to do that, that will drop your tax liability.
Great.
That's just been in the U.S. tax codes almost since the beginning of the writing of the tax code. So that's, you know, one of the reasons they're incentivizing U.S. production. That's what they're doing to help, you know, to do that and allowing us to be energy independent. But the way that works out is that there's tangible and intangible drilling costs. Intangible drilling costs take about 75 to 80% of the cost of drilling a well. And those are, you know, intangibles are obviously things with no residual value. So there's a lot of labor, there's a lot of water that's used, you know, prepping the pad, permitting, all those kind of things. Those are expenses you incur. That deduction is taken in year one. Then the tangible drilling costs, which are, you know, the jacks, the pumps, the tanks, anything that has a residual value that we could pick up and move to another site, make up the rest of that 25 to 20% of the cost. So you can combine those two and take those all in year one. So my example has always been, if you have an investor that makes $500,000 a year in US income, they make a $300,000 investment into the fund that lowers what's called their adjusted gross income to $200,000. That's the starting point now of where you're starting to report income, and then your deductions start coming below that. But someone in that income range is easily going to be in a, I'll just use a 40% tax bracket because the math is easy for me then. So if I don't want to go 43 because then I really have to think hard. But so yeah, I take that, say they're in a 40% tax bracket, you just took $300,000 off of their income. You just shaved $120,000 off of their tax liability. So it's a great planning tool is what it is as well. It's not just, it's a good investment, obviously, for the reasons we talked about earlier, because we're making, you know, we have low lifting costs and we have, you know, low acquisition costs right now, especially in this the environment we're in. But again, you get that planning aspect that helps people plan out for their taxes.
Yeah, which is the point that all nationalities, all tax reporting nations are able to access this fund. It's just there is that, and it stands up on its own. There is that added benefit of someone who has the added detriment of having to be US reporting. That this is something that can help in that planning tool.
Yeah, absolutely.
Excellent. So I think that's covered it here. Just one last question for you both, a bit off topic, but who do you think is going to win, and what do you think the next year economically is going to look like for the US? Putting you on the spot.
You want to bite that one off first, James?
Yeah, I'll happily go first. Look, as a classical economist, we'll always favor a Republican presidency. The issue has always been with Trump as a president of separating the man who is on Twitter from the man who is in the office. Speaking of us, he's been a very good president of supporting that, of actually with his trade. I mean, he can be isolationary with it. That economically, Trump in the Oval Office has been better than an Obama-Biden aspect to it. So that's where I sort of stand on that position. I would like to continue the Republicans being in power, but I would very much like it not to be the orange man. And that's sort of my perspective with it. I believe that the polls at the moment, although pretty much consistently against all polling that's happened over the recent elections, has been wildly inaccurate. I don't know anyone who's ever been asked by a pollster, which is kind of what I always find fascinating with it.
Yeah.
And sort of, I'm just asking you two now, have you ever been asked by a polling party?
No.
Who did they ask? That's my viewpoint with it. But I do believe that the margin at the moment is too much. I think that Trump last time was, his running policy was, you don't want Hillary. So that he was able to get in on that basis. I think that's not going to work this time because the anti-establishment mentality doesn't work when you are the establishment. So I think the wind is fully behind Biden. He will win because of that.
So yeah, I agree with James, a lot of what he said in that, you know, that if you look at Trump policies, they're very good. I mean, if you, like I said, took away the man and looked at the policies, I think it would be a very easy election for him. However, now you have to add in the, you know, the complication of his Twitter account and his personality. So that makes it difficult. And as far as the polling goes, I'm with you, James. I've never been called. I don't know anyone that's been called. In the US, everyone's very skeptical of the polls. So we just don't know. And if you ask me, it's too close to call because a lot of people they won't admit that they are a Trump supporter because they just don't want to have that public persona. But when they walk into the poll, when they're by themselves, I think that's when they check the box. So that's why, I mean, to me, it's still a toss up. Hopefully we'll find out by the end of November because usually we know right away. But it sounds like this election might take longer to figure out who actually wins. So, and I hate to say it, bottom line is, you know, homebound's prepared either way. So no matter who wins, the plan is in place to continue on. So I'll stay very neutral on my predictions.
Way to give an opinion, dude. Henry, what's your thoughts?
Again, I'm very much with you. I think Trump has, he's actually one of the few presidents that had a checklist and went through his kind of mandates when he went through that. From a business point, he is very, very friendly to the stock market. The stock market's liking, economists like him because he cuts the red tape from business top down. There was a recent article, Bloomberg, that said that the richest people in America had increased their wealth by $1 trillion since Trump's presidency. And that's kind of what he wants to achieve, is trickle down economics. And he's done that very well. I would prefer him from an economic point, or the Republicans, than Biden. But I don't think it looked that way. I think Biden, from an economic point, has more red tape. He'll be more kind of closed off towards businesses and less free, and that's never good for an economy, especially coming out of COVID.
So in conclusion, we would all like Biden running on a Republican ticket.
Yes.
Way to compromise, everyone. There we go.
I love it.
Yes.
I love it. And then Henry, I'm going to add one last thing in here that I should have said in the beginning, but I'm going to throw in a quick disclaimer. I know it's at the end,
yes,
but
do,
you know,
do.
usually what we come on and tell everyone is, you know, these we're expressing opinions and these are forward-looking statements. So some of the things I said and James said about the fund are things we believe will happen but haven't happened yet. Yeah. And we're not out here specifically soliciting a sale. If they're interested in the fund, you know, people can come through you and they can get access to the site and then do some self-educating for themselves to learn more about the fund. And we want to make sure everyone is, you know, has a good knowledge of what they're getting into.
Sure. We'll put a description in the link below. If you do, guys, anyone want any more information, feel free to get in touch at info@investmentforexpats.com. We'll put it all in the information on the channel as well. So that's the disclaimer part. With that, thank you very much, guys. I really appreciate it on this Friday afternoon. I hope you've got plans for the weekend and enjoy. Thank you again.
Enjoy the Six Nations and come on England.
Thanks, Henry.
Thanks, Henry.
Thanks, guys.